Hello everyone. In this lesson, we'll be learning about the binomial option pricing model. Here is our outline. First, we will use this model to find call option prices. I'll show you how to do that using the replicating portfolio approach. Then I will discuss the formulas used in this model, and then we will move on to put options and repeat the process. Okay, let's get started with call options. And I would like to motivate it with a simple example. So let's suppose you are interested in a particular stock, and the value of this stock is $100 today. Moreover, the price of the stock might increase to either 120 or it may go down to $80. So only two possible values, right? And this is where the name of the model comes from. It's binomial model, so there are two possibilities, okay? So this is the possible values of the stock, let's say in 1 month's time or in any period that you like. Now, I would like to value a call option, and let's suppose this call option will have a strike price of $90, okay? The very first thing you need to do is to find the payoff of the call options under each possible stock price value. I leave a bit of distance here because I'll write something else later on. So first, let's see if the stock is valuable, if this call is valuable, if the stock price goes up to 120. And the answer is yes, because basically, if the market price is 120, the call option gives me the right to purchase that stock for $90. So I can purchase it a lot cheaper than the market price, giving me a profit of $30. So in general, when writing the call option payoffs, we write it as the maximum of this, the difference between the stock price and the exercise price, or zero. Because essentially, if this was negative, I don't want to lose money. I wouldn't simply exercise my call option, which would be out of money in that case. So in this scenario, it is in the money and I exercise it, which gives me a payoff of $30. How about if the stock price goes down? So for example, if it goes down to $80, now it's not a good idea to exercise it. Let's understand the intuition. Why would I pay $90 for this stock if I could purchase it in the market for $80? I'm better off by basically buying it in the market rather than exercising this option. So that's why I'm not exercising it. So in this scenario, the call option payoff is $0. But what I would like to find ultimately is what should be the price of this call option. So this is a valuable contract, so I need to pay to purchase it. But how much, right? To find that value, I will form a replicating portfolio that will have exactly the same payoffs as the call option. And then the cost of forming that portfolio should be the call option price. You might ask why? It's because of an arbitrage argument and also the law of one price. So if you have two assets A and B, so let's say they have identical payoffs, right, in every possible scenario, well, then they should trade at the same price as well, because otherwise one would be cheaper than the other. Then I could basically create an arbitrage strategy that exploits that mispricing, right? And by doing that, basically the prices would adjust and the opportunity would self-destruct once the prices become equivalent to each other. Okay, so how to form this replicating portfolio? And that's where we need to introduce a new asset into the setup, and that's a risk-free bond. So let's say this risk-free bond yields a 10% return over the same period. Okay? So for example, if I purchase 1 unit of that bond, at the end of the period, I will have a 10% return and 1.1 value. Okay? And will that depend on the value of the stock? No, it's because this is risk-free. Whatever happens to the stock price, the bond will always yield a return of 10%. So if I purchase $1 worth of that bond, then next period, regardless of the stock price, I will always get 1.1. Right, so I want this portfolio of the stock and bond to have the exact same payoffs as the call option. So let's say I purchase delta shares of the stock today, and let's say the price goes up to 120. So this could be, for example, 5. So let's say I buy 5 shares, and the share values increase to 120. And let's suppose I purchase an amount of B for the bond, the risk-free bond. So it will yield me 10%. So if I purchase $1, it will be 1.10. If I purchase $10, it will be $11. Okay. So I'm going to set this equal to $30, right? So this is fine, but how about the other scenario when the stock price actually goes down? Okay, so let's say it goes down to $80. So now I still have 5 shares, but they are less valuable. My bond component of the portfolio will still be worth the same. I will get a 10% return, and I will set this equal to 0. Now, what I have here is 2 equations, right? So equation 1, equation 2 with 2 unknowns, delta and B. So I can actually solve this. There's an easy way to solve this. So what I'm going to do, I'm going to subtract the entire second equation from the first one. So if I do that, basically 1.1b minus 1.1b, these will cancel out. 120 delta minus 80 delta. So I will have 40 delta left on the left-hand side. So delta times $40. And here it's going to be $30 minus $0. So this is going to be $30. This means that delta will be 0.75. Okay, so this is the amount of shares I need to purchase. How about B? To find it, I can, for example, plug 0.75 in either of these 2 equations and solve for B. So let's plug into the first equation. So I've got 0.75 times $120. So this is $90, I think, right? Plus 1.1b equals $30. So I have b equals to 30 minus 90 divided by 1.1. So b will be 30 minus 90, so it is minus $60 divided by 1.1, and this would give you a value of minus $54.55. But I still haven't found the call option price. So again, the call option price will be the cost or value of the portfolio, replicating portfolio today, right? So what is the cost of forming this portfolio today? I'm buying delta shares of the stock times the current stock price, which is S, and I'm also investing in the bond, right? So delta, so call option price is going to be equal to this. Delta is 0.75 times $100, which is the current price, right? So I'm talking about the value of the portfolio today. And my bond investment is minus 54.55. So this is, you can think of this as borrowing at the risk-free rate. So I'm borrowing $54 at the risk-free rate. So it's like a short position. And if you do the calculation, I think what we will get is something like $20.45 as the call option price. Okay, so this is the value of the call option contract. And one final thing I would like to show you here is you can actually verify that this works by plugging in the delta and B values and double check that we exactly get the same payoffs as the call option as we should, right? So for example, if I put 0.75 here, and this is going to be minus 60 divided by 1.1. So this whole thing will be minus 60. And 0.75 times 120 is $90. So this is indeed 90 minus 60 is equal to $30. How about this scenario? 0.75 times 80 is equal to $60. Again, this part is equal to minus 60, and they add up to $0. Okay, so this works as expected as well. By the way, on our website, we have a handy calculator, which would help you to get this, use this model to find the call option and put option prices. So it might be quite useful for you to double check your answers. So just to show you, I'll put the exact same inputs. So the calculator looks like this. So we input the stock price as 100. So it can go up to either 120 or down to 80. And the strike price is $90. The risk-free rate is 10%. And it will give you all the outputs that we need. So the payoffs of the options under each scenario. So this is for the call option. The delta, remember we found it as 0.75. The amount we need to invest in the bond. And most importantly, the price of the call option today, which is exactly the figure we found, right? 20.45. So there is a link in the video description if you would like to check out this calculator. Now, let's move on to the general formulas based on this example. So this is actually nothing new. So we have exactly the same ingredients, but let me just explain you the notation. So the current price is S. So the stock price goes up to either SU. So this was 100 in our example. This is 120, or it goes down to 80, okay? And then we want to find the current call price, right? So the call option up value in our case was 30 with a strike price of 90, right? So this is 30 and this was 0, okay? And the risk-free rate was 10%. So then the delta, which we found was 0.75, is CU minus CD. So these two variables, then SU minus SD. Then we have the amount we invest in the bond, which is CD minus delta. So this is the same delta here. SD is 80 and risk-free rate is 10%. So this way you can find the delta and B. And again, the value of the call option is the cost of forming that replicating portfolio, which depends on the delta, the current stock price, and the amount we invest in the risk-free bond. So these are the binomial option pricing model formulas. Okay, so let's pause here. And in the second part of this lesson, we'll be focusing on the put options and learn how to value them using the binomial option pricing model.